Most common mistake you see retail investors make?
People get so impatient when they are into money, when they are, immediately ready to take the profit. And if there is a loss, then I don't know what happens. Suddenly that impatience goes away and they become very calm and value investor. But they don't understand, again, if there is something.
With a lot of these IPO valuations which are happening, and I think we are seeing quite a few of them, and pricing some of them appear to be aggressive. So how do you see that?
So my experiences for last 15 years, if you look at different sectors, wherever they've started with a higher PE, there are many companies. For example, I think 7-8 years back, there was one staple company which was into distribution. And it started with decent PE, but the difference is
You will find that at times the markets are emotional, no? Because it gets governed by emotions. Sometimes it gets driven by data. So how do you bring rationality to yourself?
if a business is generating enough cash, working capital is getting better, they are able to defend their margins, order book inflow is decent, then we don't.
Hello and welcome to Ventura Spotlight. It is a pleasure to have with us in this episode Mr. Ajay Khandelwal, Senior Vice President and Fund Manager at Motilal Oswal Mutual Fund. Ajay is an electrical engineer and an MBA from TAPME, Manipal. With over 2 decades of experience in equity research and fund management, he currently manages several key equity investment schemes at Motilal Oswal, the large and mid cap fund, the small cap fund, the tax saver fund, the business cycle fund, with an AUM of around 27,000 crores. So let's get started. Hello, Ajay, and welcome to Ventura Spotlight.
Thanks for having me.
So Ajay, before we dive into the markets and strategy and how the whole investing experience, so can you tell us something that what made you get into this fascinating world?
So, my journey is pretty unconventional that way. My investing career started with a broking house on sell side. Uh, and that is where I met my wife. So, I think the initial journey was more about learning. I loved her enthusiasm. And then she moved to buy side. So we had these quite entertaining engaging conversations. But I would say the next leg of learning happened when the 2008 to 9 period, when the market went down and then immediately in a span of 18 months, so much happened during the market. So I think both, I started off in a different way, but what captivated me in the market is this whole quick ride where fundamentals and emotions, you actually witnessed everything in a span of 1.5 years. From there, it has been gradual learning. So you learn every day. You figure out your style of investing, and then over period you mature. So little unconventional, I would say.
That's interesting. So I think you also got a good catch of a long-term investment in your wife.
That is true, sir.
So the other thing is like you I mean, as you said, you have seen now quite a lot of different market cycles. Again, market cycles have also become quite short. So what have been your learnings from these market cycles? What we have seen in the last 10 to 15 years.
I think every cycle, and when we talk about cycle, I'm talking about both up and down. Every correction, there was a difference. So, for example, look at the latest correction, what happened during Jan to March. Now, the reasons were completely different from the last cycle. So, when we talk about correction, I think every time there's different reason and every time we learn something. So my learning is from the market that these things will continue to happen. How, as public money managers, how we manage our risk is very important. So I prefer that my portfolio, in terms of portfolio I'm talking about now, that ideally the volatility and risk adjusted return should be better. And there, at different point in time, you need to have different construct in the portfolio. But my learning about all these, after looking at all these cycles, there are so many different factors that lead to these uh, market cycles. Our learning, clearly, we get to know more about how we react to these cycles. I think that is my biggest takeaway from all these learning or from all these market cycles is that we as investor mature every time. So yeah.
Okay, interesting. So, since you mentioned about, we talked about market cycles, you also manage, quite a lot of different types of funds, in terms of, so each one will have a different philosophy. So, how do you switch, between that philosophy, or does it remain the same? What makes you, decide the factors for that?
So I look markets in two ways. One, and when I screen ideas, so there are two things. One is you need to have certain aspects in a business. So if these are scalable models, for example, somebody is manufacturing something and distributing. Now, this is fairly predictable that you will open more stores, whether it is service or product, you will open more stores, penetrate more. So there is a sense of certainty about certain kind of businesses. Whereas certain businesses, there's always that element of uncertainty. We understand that there will be these events where the growth trajectory of that business will either turn positive, or there could be events which can actually lead to correction also in terms of business trajectory. So when we build different portfolios, we look at one is which are the scalable businesses and at what kind of growth cycle they are in. So, for example, large and mid cap fund, we look at those businesses where one is they have attained a certain size. So these are again businesses where one of these factors will not play out. The mortality risk is much lower compared to a small cap businesses. Similarly, in business cycle, we look at different industry at what juncture they are in. Suppose if there's large capex happening in an industry, we know that there'll be pressure on margins, there'll be pricing pressure. Then the capex that they have done eventually take time to turn into P&L and profits. So there are ways. One, we look at the nature of the industry, competitive intensity of the industry, the capital requirement, which is very important, and then you look at where they are in the growth journey. So when you divide between these two, then you figure out for small cap there are businesses which are different from large and mid cap, and there are businesses which are at different business cycle in their own journey. So that is how you segregate between these different schemes. Okay. But by and large, the philosophy remains the same. If I am screening any idea, there has to be certain features. So, for example, at Moti, we keep talking about QGLP. But when, as a fund manager, I try to see that the difference in what market opinion is and where stock is going to perform is at where it is at that earning cycle. If there is earning upgrades available, generally those businesses are at higher PE. Because, people get confused that this is higher PE, then so it is expensive. But what exactly is this higher PE? It tells you that the expectation of growth is much higher and for a longer period of time. That is why a market is willing to give it higher multiple. But if it is, say, a business which is where growth visibility is just for 1 or 2 years, they will never trade at higher PE. Similarly, I would say another difference which there is that the addressable size of opportunity itself is not well crystallized. So when you see that market size is expanding, you have to keep changing your numbers. And that is where I think the difference comes. So I think these 2-3 things put together, and then based on the mandate of the scheme, you build different portfolio.
So you raise a very interesting point regarding higher P, but if it has a higher growth, then it is a good investment because you are seeing some growth on that. So actually, it just brings me to a question which is in the news right now, is with a lot of these IPO valuations which are happening, and I think we are seeing quite a few of them, and uh, pricing some of them appear to be aggressive. So how do you see that in a context, specifically, when you had the Lenskart IPO, there was a lot of talk going around in terms of its valuation. Ultimately, it will be, in the future you'll come to know whether it is was it rightly priced or what it is. So how do you see this valuation game from the IPO perspective also?
So my experiences for last 15 years, if you look at different sectors, wherever they've started with a higher PE, there are many companies. For example, I think 7-8 years back, there was one staple company which was into distribution. It started with decent PE, but the difference is in ascertaining the size of opportunity. I can give you examples, different sectors. For example, MFI 15 years back when we started, we used to say the size of opportunity itself would be 1 lakh crore. And then over a period of time, it kept on increasing. Another simple example is, say, quick commerce. Now, 1.5, 2 years back, the addressable size of opportunity estimates were very different from what they are now. And that is where I think the difference is, because when you look at PE at a certain point in time, you look at that this is right now the scale of operations, and this is based on past data. But I'm not trying to justify any particular stock here, but I'm just giving you the thought process of how it generally you look at it. Is that when you look at, when we try to work more, dig deeper, do our channel checks, try and understand that a business which has got higher replacement cycle, where the consumer number of, for example, a product which is used by more number of people in a household. Similarly, where the penetration is lower, the unorganized to organized conversion is yet to happen, and will be a beneficiary of a population which is now in terms of per capita improving. When you look at all these factors, you try and ascertain what is the addressable opportunity for that business. And then you look at what are the unit economics, what actually the profit this company can deliver. Now, over lifetime, over a period of time, there could be competition coming in, which may disrupt all these equations. Today, the unit economics is something which you believe based on the competitive intensity. Tomorrow, it may be completely different. There are industries, for example, paint industry for years did very well. But then there was sudden interruption, and you can't really put it in numbers, because these are some things which you need to make changes as and when they happen. Same example as I told you about quick commerce. Now, right now, it is a large opportunity, but every time we get to know what is the size of that opportunity. Competition coming in from within the existing players versus the new players who may get in, who have access to capital. Again, that will change the whole equation. So we keep reevaluating these things when, as and when there is more data available. So it's a journey actually. And it's not something where you, at the start, you say, this is the destination, this is how I'll reach there. This is something which requires a lot of recalibration.
No, I think, yeah, very, very important point you made is that sometimes, you have a X as the size of the opportunity, and suddenly after a few number of years, it is 10X. So that opportunity increases, and that itself increases the level of business. Interesting point.
Yeah.
Okay. So when you come down to the company level valuation, what are the key matrices that you look at in terms of your portfolios, in terms of the whether it's a valuation or whether it's opportunity. So what is it that you look at in a company as some basic things which you can tell us?
As I said, you start with the QGLP framework. What happens is, first you look at quality. And in quality, what do you mean by quality is that this industry or this company to grow, what kind of capital it requires. Some businesses, by putting say 100 crore, can do a turnover of 200 crore. Other businesses can do a turnover of 500 crore. So that tells you that, okay, what is the capital requirement? Similarly, what kind of margin profile they have and what kind of margin they can defend to an extent based on the industry competitiveness, raw material supply, and other factors. Lastly, what kind of working capital this business requires? Because see what happens if a business is good, then you will get credit, you will have less payable, but that happens over a period of time. So that tells you why a staple company trades at such high multiple is because these guys, they get money beforehand, before they even delivered. So that tells you the strength that they have. So we start with that the quality of business, what kind of capital requirement they have. Then we look at where they are in the industry now, growth cycle. And based on our work, our understanding, what kind of growth longevity they have. I think these are the things that determine. And then after identifying a good idea, we need to really follow it up very rigorously in every quarterly result season. We need to see that the whole supply chain ecosystem is working well. Because if some of these parameters, for example, I said, working capital stretch starts happening, that you can understand there is pressure. So then the whole following up becomes equally important after identifying a good idea. But largely it starts with that, where what kind of quality of business, where is the growth cycle it is in. And then lastly, the valuation. Because valuation is something where if our earning estimate is very different from the street, then our valuation, starting valuation is very different. But generally we look at price earning to growth ratio, because we believe you can't get a 30% earning growth company at a similar multiple in the same industry as a 10% growing company, because the growth profile is extremely different. So yeah.
Okay. So, just for the benefit of, people who may be not understanding the QGLP as a concept, if you could just, explain the concept, because that is quite, prominent with Motilal Oswal as a group. So if you could just elaborate a little bit on it.
QGLP is mainstay of our investing philosophy. Q stands for quality, where quality is about management, what kind of past decisions they have taken, if they have put up capital, what kind of return that capital has generated. That tells you scalability of the business. G stands for growth. Now, growth, certain industries where the industry level growth is say 5% and some companies growing at 15%. That tells you that the company is growing at 3x, 2x the industry growth. So G stands for growth. L stands for longevity. Now, whether this growth is for 1 year, 5 year, 10 year, because the whole valuation changes based on that. I think this is where the maximum compounding is captured. And P is finally the price, where what do you pay for it, where we believe we use a mix of parameters there. But if a business is more predictable, then we use DCF. If a business is in a growth phase, we use price earning to growth. We use relative valuation to their own history. So it's again a combination of different factors then.
Yeah, so quality of business, growth prospects, longevity of the business, and finally the price is what you pay.
Absolutely.
For the idea. Okay, I think it's a very good concept to actually follow it up on. So now, I mean, when you do all this, right, and we always find that ultimately markets will behave the way they want to behave, right? So you will find that at times the markets are emotional, no? Because it gets governed by emotions. Sometimes it gets driven by data. Okay, so it's a collective wisdom of everything. How do you react when you find that sometimes the market is going completely at a tangent to what your thought process is? So how do you bring rationality to yourself?
I think over a period of time you get mature. So after seeing different cycles, you become very objective. We look at numbers without emotions. We look at all these things which I told you. If a business is generating enough cash, working capital is getting better, they are able to defend their margins, order book inflow is decent, then we don't get distracted by it. Because what happens is we have seen, and over period we have realized that the liquidity also plays an important role, because when market comes down in a sharp manner, generally the liquidity is very low. And we as public money managers, we also know that if there is fear on the street, market is correcting, we don't have to go and buy it every fall. We are managing public money. We can get a better price. Nothing, we are not pushed to immediately rush into and react to it. So I think that maturity comes over a period of time, and again based on different kind of events. For example, if tariff is something, well, this has been dragging for last 1 year now. So every time, I would say in last 6-7 years, the nature of event is very different. We are, as an economy, we are more matured. As a market, we are more matured to handle if oil prices go up or down, currency change, inflation, interest rate. But if a COVID happens, if a war happens, if a tariff drag happens, these are things where you need to see, understand, finally may see your portfolio, how is the impact of it, and then be rational about it, because once it happens, after that you understand the impact on your portfolio and then behave rationally. But I would say that every event right now which is happening is very different. Earlier it was more about oil prices or some commodities or inflation, but now the corrections are happening because of very different reasons.
Right. So you also manage the the business cycle fund, and that is one of a very prominent theme across. We find everybody is trying to have that, and there are two things to it. One is that, do you think that now the business cycle which happen are shorter and faster, so you need to be more nimble and agile? Or do you think that you can identify there could be some business cycles which you can identify as a longer term cycles, and there'll be a longer time horizon? How do you see the business cycle as a theme per se?
So in India, where we are at this point in time, I think there are certain structural themes which are playing out. For example, as we have seen in different economies at different point in time, when your per capita increases, the behavior of consumption changes. So that premiumization is something which will continue to happen. Similarly, because of formalization, I think the unorganized to organized shift will continue to happen. When technology use started happening, we saw improvement in margins for a lot of businesses, even in banks, for example. I mean, the large private banks, their cost to income improved by maybe 500, 700 points by use of technology in last 5 to 10 years. So those themes will continue, I think, for next maybe decade plus. Manufacturing is something which I think in India is seeing that revival, where when we are seeing meeting companies, we see that in last 5-10 years things look very different now. Precision engineering, for example, and the kind of machines these people are putting up, the kind of skill set they are looking, the kind of clients that they have, which actually take years to onboard. So a lot of those things are happening. So manufacturing is something which I think is a theme which will continue. Digital, both on the adoption side and on the producer side, is seeing a lot of scalability. So there also, I would say certain businesses will benefit because of adoption of digital. So these are some of the themes which I believe are structural, whereas in small caps, there are cycles are really getting shorter. You see 3 years time, post-COVID, there's war that happened. So capital goods suddenly started seeing a lot of traction. The way generation of electricity across the world how it moved towards renewables, and now coming back actually to thermal. The shortage of transformer or some of these products, suddenly the dearth of availability across the globe is something which is there. The data consuming industries, the way they require power. So a lot of these things are happening in short period where capacities cannot come up immediately, but eventually that will normalize. Now, if adoption of EV, for example, happens in a quick time, then certain ancillaries will see a lot of demand. So we are seeing defense, for example, another industry and as in when things are changing, the whole addressable opportunity that we spoke about, defense is another prime example how they're evolving. So I think some of these sectors are seeing cycles where, as and when capacity will come up, we will see normalization of earnings.
So manufacturing and digital are more longer term structural business cycles which you would bet on.
Yeah.
Okay. So we have also seen like our Indian markets have they have changed over the last 10 years from what you would have seen. We have seen a sea change, specifically when you look back now. So what do you see going forward the next 5 to 10 years? Do you see any more structural changes you think are likely to happen, or anything which you have your thoughts on?
I would break it in two parts. One is in terms of macro. I think in terms of macro, I think we are becoming far more stronger compared to earlier times. When now with currency volatility, I think markets have behaved in a very rational way. Some of these macro parameters will be important, but the way our economy is expanding, they will become more favorable, I would say, over a period of time. And in terms of sectors and businesses, as I said, I think there's clear change in how promoters are thinking about capital deployment now. Because of market now becoming, and with all these IPOs and market performing so well, there is clear now understanding in the mind of promoters also that if they put their capital to good use, market rewards them more than what they can think of. So I think market is becoming richer, deeper. Liquidity is also improving. We have so many, these new IPOs which are coming are into very different industries from the past. So I would say that market is improving as a whole, and this will be reflected, I think, in sustainable performance over a period of time.
So another thing, Ajay, is that now we have investors is spoiled for choice in terms of whether it is number of funds, and we have seen even an increase in the number of fund houses, right? So we have across I think now 50 plus fund houses, and everybody has their own scheme. So investor, when he has to look at what would be your suggestion, because each large cap would also be different from the other guy, whether a mid cap or a small cap. There are different types of ratios, and so if you had to give an advice, unbiased, I mean obviously your first choice will be Motilal Oswal, but if you had to give an advice to an investor that what is one parameter he should look at in terms of selecting a fund, from return is the most obvious parameter, but behind the return also, like you also mentioned about that the getting a better risk adjusted return, which I think is a lot of investors do tend to miss out on that. So if you could share some thoughts on that.
So my thoughts on this is that mutual fund still is a push industry according to me, and the Indian investors, they have what it is required. They are patient. For example, they'll invest in real estate and hold on to it without any returns. It's an illiquid asset, but they are okay with it because they think of it as a safe asset. Similarly, the second thing that is required in investing is you need to understand the product, spend time on it. I've seen people spending time and discussing feature phones of a smartphone, now smart TVs, for fair period of time. But when it comes to equity, there is less familiarity. That is why the allocation of equity itself is so low. Because as I said, equity requires one is understanding, patience, and the ability to discern, which both Indian investors have. So I would say first, please understand that every asset class has got its own risk return profile, and equity has a very different from other asset classes. And then look at the portfolio, use these advisors because they are doing really good job in terms of asset allocation. And funds, I would say, based on your risk profile, look at the which kind of scheme fits your overall investment profile. And then finally, all these over a period of time, you'll understand, okay, what is the AMC's philosophy? Over a period, what can you expect? So I think this is a process this is a journey actually, which as soon as they start with these right fundamentals, it will be very rewarding.
Okay. So yeah, actually, Indian investors are patient in specifically in real estate. I don't know about the equity market in terms of how much of that patience is there. So, but a good thought process. So now we have you have been through various market cycles keep on happening. What are your which is the core investment principle you always always have it at your heart that you always will follow that irrespective of whatever is happening in the market?
Uh, See, over cycles, what we have seen is that there would be all these uh, pulls and pressures in terms of competitive intensity. But certain industries are inherently more profitable. I mean, if prices have corrected without any reason, I would love to buy those businesses because inherently they are more rewarding for investors. The less competitive intensity, better cash flow generation, ability to redeploy those cash flows again, so you get the benefit of compounding. So during actually sharp correction, this is perfect time because for as fund managers, we have crossed that hurdle where we get really impacted by, and so it's for us, it's not an emotional ride when markets correct. For us, we are very objective that way. So I want to use those cycles to really strengthen my allocation and my portfolio. But generally, no. If you ask me something which I pay attention to at all times, it is if a business cash flow is deteriorating, it is challenging.
Okay.
Yeah, relative to their own history, peers, because every industry will have different capability to generate cash. If a business is growing at 40%, you can't expect them to generate free operating cash flow. So, I'm saying based on the nature of the industry, growth profile of that industry. But if you ask me across period of time, it is cash flows determined.
So, what personal habit or routine you follow to maintain your sanity in the insanity of the markets?
I would say not everything is captured in numbers. When you read every day about what's happening, if you skim through 4 or 5 newspapers, you get so many data points that helps you in understanding that the industry that you are focusing on, how is the landscape changing? So, give you an example. If suppose I like a auto ancillary company. Now, if I believe that the logistics guys are doing well, the finances are doing well, the states which that company is into, those states, I see that a lot of good news flow coming into that. That gives me a confidence that yes, this will do well. So, to keep sanity, if you ask me, a lot of this qualitative things give you confidence that yes, you're apart from the numbers, things are moving in the right direction. So I think these small things like you need to read a lot, it helps. And it builds conviction, because for long you can't work on borrowed conviction.
Okay.
Yeah.
Nice word. You cannot live on borrowed conviction. You need to have your own conviction.
Yeah.
I agree with you. Okay. So, and when you wind up, how do you unwind yourself?
See, again, depends on phases of market. Sometimes when market is too volatile, believe me, however hard you try, it plays on your mind. So generally, we have our own cycles that way. But yeah, with friends, you go out, play different sports, be it card gamers, other games. Yeah, that's what.
I would end with a rapid fire with you. So, we'll just do that. One habit every investor should build early on.
I think, as I said, they need to understand that every asset class, what is the return that it can be expected from that asset class. And if you build familiarity with that asset class, you will be aptly rewarded.
Okay. A sector you believe will define the coming decade.
For India, as I said, manufacturing and digital is something, because the other sectors are more cyclical in nature.
Okay. The most common mistake you see retail investors make.
I think everyone knows about it. People get so impatient when they are into money, when they are, immediately ready to take the profit. And if there is a loss, then I don't know what happens. Suddenly that impatience goes away and they become very calm and value investor. But they don't understand, again, if there is something which is maybe stock is fallen or there is correction in the market, there's a reason behind it. So I would say retail investors are very quick in booking profits, whereas the same behavior is not displayed on the other side.
So they actually need to ride the profits and cut the losses. If you had to pick one between fundamental or momentum.
Always fundamental, because momentum is something, as public money managers we know, eventually it is not sustainable.
A skill outside investing that helped you become a better fund manager.
I think, maybe poker really helps. There's a lot of similarity. I mean, I don't know. I'm sure other fund managers also must have spoken about it. There's a lot of similarity between the game and investing.
Like the answer, poker.
You look at different odds and you try to right size your bets. Yeah.
So one word that captures the current mood of the Indian equity market.
So we, among ourselves, we also discussed it, and then we put it on Chat GPT to see what is a good one-word answer to that. So I think the answer was euphoric equilibrium.
Oh, wow.
So I'll explain what is it. It's like you're happy about it, but you're pretending you're cautious, which is what is happening in the market. People are looking at 1 year return, but they know things are improving. Macro is supportive, earnings now, the earning downgrade cycle is stopped. But at the face of it, they are more cautious, sounding more cautious. So I think I like that word.
Oh, wow. Euphoric equilibrium.
Yeah.
A financial term you think people pretend to understand but actually don't.
I've seen people using this alpha and beta a lot, many times. But I don't think that the right understanding is as widely there as it frequently it is used.
Okay. What's the strangest question you've been asked as a fund manager?
Investors and generally during distributor meetings, it is more about that short-sightedness, why market is correcting and all. I mean, these are not strange questions. Obviously, they expect fund managers, but there is a limitation to it. At home, my son, for example, when he hears me talking, he thinks that we own that money. So then he's like, you talk about all these large numbers. Then where's the problem? Allow me to spend whatever I want.
Good one. One finance term you secretly wish had a simpler name.
I always get confused with this contango and backwardation. And now I'm more confused with this latest pre-Ind AS and post-Ind AS numbers. So, now companies have started reporting it differently. So we need to pay attention to that also. But yeah,
Thank you, Ajay. It was a pleasure having you on our spotlight.
absolute
Thank you.
pleasure, sir. Thank you.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully